Welcome to the Deep Dive, the show where we really get into the weeds on earnings calls.
Bringing you the core insight.
Exactly. Today we're looking at Park Aerospace Corp, ticker PKE. They just reported their Q1 for fiscal 26.
Yeah, they're a key supplier, right?
Especially
composite materials for aerospace, defense, critical stuff.
Critical stuff indeed. And here's the interesting part. They actually had a modest beat, top and bottom line.
Mm-hmm.
But the market pulled back. Stock dropped on higher volume. So something's up.
Yeah, that's the puzzle, isn't it? The numbers looked, well, fine, decent even, but investors, they clearly reacted to something else.
Let's unpack that. So first, maybe just run us through those key numbers from the quarter.
Okay, sure. So net sales came in at $15.4 million, pretty much right on target with expectations.
Okay.
Diluted earnings per share, EPS, that was $0.10, just a little bit ahead of what analysts were expecting.
Slight beat.
A light beat, yeah. And a definite positive was the gross margin. It expanded year over year to 30.6%.
That sounds pretty healthy.
It is, and that helped boost their adjusted EBITDA to $3 zillion, even though revenue actually dipped a bit from the previous quarter.
Okay, so sales down sequentially, but margin up.
Yeah.
Got it. So decent headline numbers, but you said the market reaction was cautious?
Cautious is a good word.
Yeah.
It felt like investors just sort of shrugged off that small EPS beat.
Right.
And instead, they focused on, well, two main things. One was that softer sequential revenue number we just mentioned.
The quarter-over-quarter dip.
Exactly. And the other was the company's pretty significant plans for capital spending, for CapEx. We saw a definite rotation out of smaller aero suppliers around that time.
Interesting. So caution maybe about execution in the second half?
Seems like it, even as the big defense players held their ground. And you even saw more put option activity on Park, which suggests some investors were betting on the price going down further.
Okay, so there's definitely some unease there, despite the okay numbers. Let's dig into that gross margin improvement then, over 30%. You said it was a positive. How'd they manage that? Was it like a sudden efficiency gain?
Not exactly a sudden gain. It was more about reducing some drags they've had.
Okay.
Management pointed to, well, basically three things. First, less of a negative impact from their new manufacturing facility.
The one that's still ramping up.
That's the one. It's underutilized, still costing them money, but the drag was less this quarter. Second, they had a healthier product mix, meaning they sold less of their lower margin C2B fabric, only $1.1 million in Q1 compared to $4.4 million in a prior quarter. So the ratio of fabric to finished, higher margin materials was more typical, more profitable.
Gotcha. Less of the cheap stuff.
Pretty much.
Yeah.
And finally, they said production levels were just better matched with sales this quarter. Unlike before, where producing less than they sold actually hurt margins.
So it sounds like things are stabilizing operationally, maybe? Less headwinds.
Yeah, that's a good way to put it. Stabilizing the ship.
Okay. But even with the market jitters, management actually raised their full year sales guidance.
They did, yeah. The CEO pointed to strong demand from GE Aerospace engine programs. And this is key, the really urgent need globally to replenish missile defense systems.
We'll definitely need to talk more about that. What about the near term, Q2?
For Q2, they're estimating sales between $15 and $16 million and adjusted EBITDA around $3.0 to $3.4 million.
Okay.
And they made a point of saying these aren't, guidance figures they set low just to beat them. They said this is their best honest estimate.
Right, setting expectations realistically. Okay, so if the current numbers didn't wow the market, maybe the strategic stuff will. Management seems really focused on these big growth drivers. Let's start with GE Aerospace. They call it a juggernaut. What's the story there?
Yeah, this is where you see the longer term picture. They clarified a couple of things. Their relationship with MRAS, that's Middle River Aerostructure Systems, a GE company that's under one long-term agreement, an LTA, running through 2029.
Okay, that's established.
Right. But they also have a new LTA directly with GE Aerospace itself, covering different engines, different materials. And crucially, all of that revenue potential gets rolled into their overall GE Aerospace forecast. It's a deep partnership.
And the specific programs driving this, are they seeing progress?
Oh, yeah. Good news on several fronts. The Airbus A321XLR, the long-range version, saw a huge $12.3 billion deal for up to 70 planes.
Wow.
Then there's the Chinese C919. They're aiming for 200 aircraft a year. And the U.S. apparently lifted the export ban for its low EP engines. That's big.
Very big for that program.
And Boeing 777X, still on track for certification this year, service entry in 2026. It's flown over 1,400 times already.
So the demand pipeline looks solid.
It does. For Q1, their GE engine program sales were actually above forecast at $6.2 million. And the full year forecast, still $28 to $32 million. They see it building towards potentially $61 million a year down the line.
Okay, that's a serious growth engine.
Yeah.
But it's not the only one they highlighted, right? There was this war and peace segment, missile defense.
Yes, and this feels even more critical right now given everything going on. Management used strong language, urgent, desperate need to replenish missile defense systems globally.
Because of depletion from recent conflicts.
Exactly. Middle East, Europe, stockpiles are getting seriously low. They gave some examples that really put Park's position into perspective.
Like which ones? What's the prime example here?
Probably the Patriot system, the PACE-3. You're hearing reports of the largest deployment ever, systems moving from allies to hotspots, which is draining reserves in places like Israel, Ukraine.
Yeah, you hear about that constantly.
The U.S. itself apparently only has about 25% of the Patriot missiles needed for its own military plans. It even caused temporary pauses in aid deliveries.
25%, that's stark.
It is. But despite that, or maybe because of it, announcements are signaling way more shipments coming. And one report, actually from a Russian news agency, said the U.S. Army plans to boost PACE-3 procurement by 4 times.
4 times.
Okay.
And Park's role?
They are the sole source qualified supplier for critical specialty materials on the Patriot. Sole source. And they've been asked directly to increase their output by, quote, significant orders of magnitude.
Significant orders of magnitude.
Yeah. The company even said their planned new capacity, it might probably not be enough. They're negotiating right now on a potential blanket order worth up to $40 million just for their C2B fabric for this program.
Incredible. So it's not just replacing what's used, it's a massive buildup. Is it just Patriot or other systems too?
Oh, it's broader. Look at the Israeli Aerosystems. Aero 3 has been used heavily. Aero 4, which targets hypersonics, is in final development. Germany is buying these 2 now. Big demand.
In Park's position there.
They're qualifying for Aero 3, and they're already the sole source supplier for Aero 4. The signals are all acceleration.
Okay.
Then you have the Sentinel program replacing the U.S. Minuteman III ICBMs, hundreds of missiles. Park has history here. They worked on the original Minuteman back in the 70s. They couldn't say much, but implied they're involved.
So it's across the board, air defense, hypersonics, strategic deterrence.
Right. And they mentioned supporting other highly sensitive defense programs they can't even name with significant revenue potential.
And they don't see this demand dropping off anytime soon.
Definitely not. They specifically said they're betting against a scenario where peace suddenly breaks out and defense spending craters like it did after World War II. They think this is a long-term shift.
Okay, well, if you've got that kind of demand picture, both from GE and defense, then planning a major manufacturing expansion makes a lot more sense.
Exactly. That's the driver.
So what's the plan? How big are we talking?
It's major. A new plant, maybe in Newton, Kansas. It would make solution hot melt film, hot melt tame, and crucially, hypersonic materials.
Okay. And the cost?
The early budget is $35 million, give or take $5 million, but management kind of hinted that number may be a little low. They might need more.
$35 million plus.
Yeah.
For a company with about $15 million in quarterly sales. That's significant. Why the urgency? Why commit now?
Because the demand forecasts, especially since May, have gone even higher. They need the capacity and flexibility for these opportunities, and building this stuff takes time.
How much time?
Years. Probably 5 years before qualified products can ship from a new facility like this. So they feel the timing is now, hesitate, and they could squander these very special opportunities. They called them potentially once in a lifetime.
Once in a lifetime.
Yeah.
Strong words. But investors, as we said, seemed wary of the spending. How did management counter that potential criticism?
Yeah, the CEO addressed it head on. Pointed to Park's 72-year history, their financial discipline, zero debt, strong cash position. They've paid out over $600 million in dividends over the years.
Right, they have a track record.
Exactly. He framed not investing now as the truly irresponsible move, given the scale of what's in front of them. They expect to finalize the plan by the end of this calendar year, then move to implementation. Hopefully more details on the long-term forecast by the Q2 or Q3 call.
Okay, so we have this picture. Strong underlying demand, management conviction, big investment plans. But the market immediately sold off after the call. What gives?
It really seems to be that combination, right? The slight sequential dip in revenues spooked some people, and the sheer size of the CapEx plan made others nervous about near-term execution and cash flow.
Even though the long-term story sounds compelling.
Apparently,
Yeah.
that rotation out of smaller suppliers, the put activity, it points to near-term worries overshadowing the longer view for some investors right now.
But the stock had run up before the earnings, hadn't it?
It had, yeah. Up about 14% in the 6 weeks prior. People were optimistic about dividends. Those Patriot fabric orders were getting noticed.
So the pullback kind of just erased those recent gains.
Largely, yes. The stock is still up for the year around 8% year to date, last I checked. So the market seems to be weighing things. Clear long-term demand versus near-term spending and execution risk.
And financially, can they handle this $35 million plus expansion? What does the balance sheet look like?
It looks strong. Zero long-term debt. They ended Q1 with $65.6 million in cash and marketable securities.
Okay, so they have the cash.
They do. It was down slightly from the previous quarter, $68.8 million, but they explained that. There was a $1.5 million advance payment for that C2B fabric and about $2.1 million spent on share buybacks.
Normal course of business stuff?
Pretty much. They also noted a final $4.9 million tax payment hit in June, so that'll affect Q2 cash. But yeah, with that 40-year dividend history and $600 million paid out, they've shown they can manage their capital effectively. Oh, and tariffs. Minimal impact, less than a few $1,000s in Q1. Mostly passed on. Not a concern right now.
Right. Okay, that sets the stage nicely. Now let's shift gears to our This Is Not Financial Advice segment. Given everything the defense demand, Park's sole source spots, the stock pullback, what's an outrageous but maybe plausible trade idea here?
Well, thinking contrarian.
Yeah.
Maybe going long Park Aerospace.
Long, despite the market's reaction.
Exactly. The outrageous part is betting against that initial negative sentiment. The logic is that the market could be seriously underestimating this missile defense demand surge.
The once-in-a-lifetime opportunity.
Right. Think about it. Reports of a 4x increase in Patriot procurement. Park being asked to ramp up by significant orders of magnitude, and management saying even their new expanded capacity probably won't be enough.
Implying the demand is even bigger than they can currently plan for.
Precisely. So yes, the CapEx is a big chunk of change now. But if that demand translates into the kind of revenue growth implied, it could completely dwarf these near-term spending concerns down the line.
So the bet is that future earnings growth will eventually force the market to re-rate the stock higher.
That's the idea. You're betting that the sheer geopolitical urgency, the desperate need for these systems Park supplies, isn't fully priced in yet because people are focused on the Q1 sequential dip and the CapEx number. You're looking past the immediate reaction to capture a multi-year growth story.
Going against the grain to bet on the war and peace juggernaut definitely fits the outrageous but plausible description. Okay, let's wrap this up then. To recap, Park Aerospace's Q1 had solid underlying results, good margins.
But investor caution won the day, focused on that slight sequential sales dip and the big CapEx announcement.
Right, but the bigger story from the call was this powerful long-term narrative. Massive, urgent demand in aerospace and especially missile defense, where Park has these critical, often sole source positions.
And management is clearly all in, making huge investments now because they believe this opportunity is truly unique and time sensitive.
So the final question for you listening is, what resonates more? The market's immediate caution or management's powerful conviction about a future driven by these massive global forces? Something to think about.
Definitely. We love hearing your thoughts too, so if you have questions or ideas for other calls we should dive into, let us know.